Hi everyone, Chapter 1. Just want to give you a brief overview of what we're going to go over. There's three activities in regard to accounting that deals with identification, recording, and communication. And we have two different types of users when we deal with financial statements. We have internal, such as management, supervisors, company officers, and we have external users. You can be an investor, creditor, like a bank, or other users like the IRS, customers, labor unions, suppliers, what have you. Let's go to the next slide. There we go. The account equation. This is pretty important. Probably one of the most important things I'd like you to master in this class. Basically, this is saying that assets equals liabilities plus owner's equity. This is the actual accounting equation. Assets are resources that possess future economic benefits. So basically, they're cash, accounts receivable, supplies. Liabilities are claims or creditor claims on the assets and represent debts of obligations of the entity. These are things such as accounts payable um, to other creditors, salaries payable. That's where your employees have some claims, basically their paychecks. And owner's equity. Equity is the owner's residual claim on the total assets. And the reason why we have liabilities first in this equation is basically that's going to be considered the right side of the equation. Liabilities plus owner's equities is the right side, assets is the left side. Creditors' claims on assets are first because in the event of liquidation, creditors are paid first before the owners. So that's the reason why there. Let's review something called transaction analysis. Basically, Sam Dottie opened his law practice during the month of September, provided you with the following data. Invested $8,000 in the business. So down here, it's something called transaction analysis where I have assets equals liabilities plus owner's equity. Again, this is the left side, and this is the right side. Whatever we do on this side has to balance on that side. So transaction number one is represented by $8,000 in cash. So we have plus 8,000, and we add 8,000 to the capital account, owner's equity. So basically, assets equals liabilities plus owner's equity. In this case, we have zero liabilities. So that equals. Number two, purchased $500 of supplies for cash. We use cash here, so minus $500. However, we added $500 here for supplies. So basically, this only affects the left side of the transaction, left side of the account equation. And same thing now over here from 3 to 8. You can see these examples, and you can actually stop this video anytime you want. I'm just going to move forward. As you can see at the end, all this will equal the 7,500 and the 4,000 will equal 3,000 plus 8,500. So we'll take that information, take this information from here, owner's equity, not this investment, but the service revenue, salary expense, rent expense, and drawing. That's actually going to go over to the income statement. And you can see how it flows over here. The rent, service revenue, the expense, and the drawing all come down to here to make the income statement. So service revenue, 3,000. You have your expenses. Subtract your expenses, you get net income. And the $8,000 investment comes down here to the owner's equity statement, which tells you what has changed in the equity of the business. So basically, we started with 0, we added the 8,000, we added the 2,000 net income to come up with 10,000. However, in one of those scenarios, the owner withdrew $1,500, and that gets our ending balance. Running a little shorter here on time. We got about a minute left. I'm limited to 5 minutes here. Same transaction that we dealt with in the past in the same illustration. Cash, supplies, equipment, these are assets. Accounts payables, 3,000. And you can see how they flow down here. These three are assets. You'll see here. Cash, supplies, equipment. Accounts payable over here. And the same thing with capital account over here. Cash flow statement. You can check that over in the book. We're going to learn more about the cash flow statement in the last week of the class, but read through here. Cash flows from operating, investing, and financing activities. And you can pause this anytime you want. Here's the answers down here. Basically identify the various transactions indicated by the following performed. So an increase in cash, a decrease in accounts receivable is basically what we're doing. If we do see that, we have a collection of accounts receivable. So let me know if you guys have any questions.